Hi everyone, thank you for joining us today to go through the autumn budget changes. We are just waiting for a few people to come into the lobby, so we will begin this in around about a couple of minutes' time. Be a couple more just joined, so I think there's just a couple more that we're waiting on, and then we'll begin. James, over to you.
Thanks, Henry, and thanks to everybody for joining us for a run through of the main changes in the new government's first budget. So Henry and I will speak for around about 25 minutes or so, after which we'll answer any questions that you may have. So see from the attendance list that we've got a good mixture of business owners and private clients with us today, including some non-DOMs. So hopefully there'll be something here for everybody. So I think the first thing to say is that there was a very big gap between the new government taking office and its first budget, and this allowed for a great deal of speculation to grow as to possible tax rises. So it was very good in the end to get some certainty as to what's actually going to change. So as expected, we did get some big changes in areas such as employers' NICs, CGT rates, VAT on school fees, and also on IHT. We also got full details of the abolition of the tax rules for non-UK domiciled individuals from April 2025 and its replacement with a residence-based regime, which is a big change. There were also some surprises in the budget. For example, the government increased the stamp duty, land tax, additional property surcharge, and that went up 2% to 5%. We'd also expected some modifications to the government's plans for non-resident trusts in respect of IHT, which would have cost very little in tax terms, but they did not materialise in the end. What we didn't actually see in the end were the rumoured changes to income tax relief on personal pension contributions, the imposition of NICs on employer pension contributions, or a reduction in the 25% lump sum pension allowance. So all that was good news because they were quite worrying rumours. So Henry's going to start us off with a summary of some of the things that haven't actually changed before moving on to some of the main changes in CGT and employers' national insurance contributions.
Yeah, thanks, James. Yeah, like James mentioned, before we delve into the announcements to the main occasions, since Labour won the election, these would not be increasing taxes for working people. That means that the basic rate, higher rate, and additional rate of tax all remain the same at 20, 40, and 45%, as well as employee national insurance rates remaining at 8% and 2%. The personal allowance will remain at 12,570. The basic rate band will remain on income up to 50,270. The higher rate up to 125,140, and then the additional rate for any income over that. These bands have been frozen now until 2028. Another topic that the Chancellor announced would not be changing was the rates to corporation tax. The rates for small profit companies, which is less than £50,000, will remain at 19%, 25% for profits over 250,000, and the marginal rate for companies with profits in between these two thresholds. This works on a sliding scale, with the corporation tax rate gradually increasing with the higher the profit, the higher the tax rate, up to 25%. Just on a change in regards to wages, the national living wage will rise from £12.21 per hour from April 2025. For 18 to 20-year-old employees, the minimum wage will increase to £10 per hour. This pay rise will increase annual earnings by around £1,500 for full-time NLW workers. Now into one of the biggest announcements from the budget, was the significant changes to employers' national insurance. From April 2025, the rate of employers' national insurance contributions will increase by 1.2%, from 13.8% to 15%. Another change, and potentially more impactful, the secondary NIC threshold, which is the amount from which the employers start paying their national insurance contributions, will drop from 9,100 to 5,000 per employee. This threshold decrease means it will cost an employer an additional £615 per employee in employers' NIC. To subsidise this cost, particularly with small businesses, it was announced that the employment allowance will increase from £5,000 to £10,500. This has been elevated to assist those employers with less than 10 employees, as on this basis, the only additional cost these employees will have will be from the 1.2% increase. In addition to this, previously, if your employer's national insurance liability in the tax year exceeded £100,000, you would not be entitled to receive the employment allowance. This limit has now been removed, and most employers will now be entitled to the £10,500 allowance. The rules around connected parties and employers operating multiple payrolls will remain in place, meaning only one employment allowance will be able to be claimed by an employer. Another large change in this budget is the highly anticipated increase in capital gains tax. There was speculation that CGT would increase to align with income tax rates. However, this did not happen. Instead, the standard CGT rates have increased to align with the property CGT rates, with the main rate, this is for income and gains below 50,270, increasing from 10% to 18%, and the higher rate of 20% increasing to 24%. These rates are effective as of the 30th of October, so they are in place now rather than at the end of the tax year. In addition to this, business asset disposal relief has also been impacted. This is previously known as entrepreneurs relief. Currently, the relief provides a flat 10% CGT rate on qualifying business disposals up to a lifetime limit of £1 million. From April 2025, the rate of BADR will rise from 14% and align with the main CGT rate of 18% in 2026. This means that from 2026, the maximum amount of tax relief that will be obtained from a qualifying disposal will be £60,000 on a £1 million disposal. Quite a change from previous years. Under the entrepreneurs relief rules, the lifetime limit was in fact 10 million, meaning you were previously able to obtain £1 million worth of relief from your CGT liability. In addition, investors relief, which is less well known than BADR, this is available to individual investors who invest in companies that are not actively involved in the business. Investors relief was based on the previous entrepreneurs relief rules, with any qualifying disposals for investors relief taxed at the main rate of CGT, with a lifetime limit of £10 million. This limit has now been reduced to £1 million to then bring in line with BADR. Again, previous you would be able to obtain up to £1 million worth of relief from your CGT liability, and now this again will be limited to
I can't hear you, Henry. I don't know if I'm supposed to move on now to my bit.
yes, you're a bit
Sorry,
now.
Henry. Yeah, sorry, cut out there for 30 seconds or so. So thanks for that, Henry. So moving on to the non-dom changes. So these were highly anticipated, and a vast amount of information has been published on this by HMRC. So I'll focus on the main changes. We've actually put together our own summary, quite comprehensive summary of all the changes that people need to know about. So I'll do my best just to kind of keep this brief. So essentially, the government's confirmed that the non-dom tax regime is being abolished as from April 2025. So this means the end of the remittance basis of taxation for non-doms in respect of their foreign income and gains, and the end of UK tax protections for most non-resident trusts which have been set up by non-doms. So they're fundamental changes to a system that's been around for many, many years. So what we're going to have in its place will be a new residence-based foreign income and gains regime, which is being referred to as the FIG regime. So this is very similar to the plan set out by the previous government. Under the new system from April 2025, new arrivals to the UK and current UK resident non-doms who have been resident here for less than 4 years will not have to pay tax on foreign income and gains in their first 4 years of UK residence. And they're going to be able to bring these funds over to the UK on a tax-free basis. So this is a very big change to the current regime, which is whereby non-doms are taxed on remittances made to the UK. So that's going entirely. So under this new system, providing a claim is made for the FIG regime to apply, remittances are going to be able to be made at any time to the UK. They don't have to be made in the first 4 years of UK residence. And once that 4-year period is gone, from year 5, foreign income and gains will be taxable whether or not they are remitted to the UK. So like a normal UK person is taxed on the arising basis, we call it. So the 4-year honeymoon period, if you like, is very, very favourable for as long as it lasts, but it's very short compared to the current system, whereby there's a 15-year period in which non-doms have been able to protect their foreign income and gains from UK tax. Certainly other countries have much more favourable tax regimes, which also last for a lot longer than 4 years. So also from 6th of April 2025, those who don't qualify for this new FIG regime will be taxed on their foreign income and gains as they arise. And this includes income and gains from non-resident trusts, of which they are both a settlor and a beneficiary, known as settler interested trusts. So the government's going to, for people who are affected by these changes, the government is actually going to introduce some reliefs, which again were originally mooted by the previous government. So the first is the temporary repatriation facility, and this is going to allow pre-April 2025 foreign income and gains, which have been the subject of a remittance basis claim and which haven't yet been remitted to the UK, to be brought into the UK on favourable tax terms. So this includes trust income and gains, as well as personal income and gains, and it also includes assets in which foreign income and gains have been invested. So that's very useful for liquid assets in which foreign income and gains are tied up. So this facility is going to be applying for a 3-year period from 6th of April 2025, with tax rates of 12% for 25-26 and 26-27, and a 15% rate for the 27 to 28 tax year. Any foreign income and gains remitted to the UK outside the 3-year window will be taxed at normal rates, and these are up to 45% for income tax and 24% for capital gains tax. So clearly this facility is a very good opportunity to remit funds to the UK on favourable terms. So some non-DOMs should therefore think about triggering foreign income and gains for the current tax year, make one final remittance basis claim for this year, and then remit the money to the UK after the 5th of April 2025 at those favourable rates under the TRF. As I said, the best rate is 12% in 25-26 and 26-27. So just one more word about how the TRF works. So once which is a temporary repatriation facility, once it's paid, then no further tax is due, but it won't be possible to claim any foreign tax credits in relation to amounts remitted to the UK under the TRF. And just in terms of the detail on the TRF, it's not like the remittance basis claim where taxpayers simply say, I want to be taxed on a remittance basis. Under the TRF and also with the FIG regime, specific income and gains are going to have to be identified as those which a taxpayer wants to benefit from under both the FIG regime and under the TRF. So it's a different system. So there's a second change that the government is also providing affected non-DOMs with, and that's the capital gains tax rebasing. And that's going to be at 5th of April 17. And so that's for non-DOMs who've claimed the remittance basis at any time between the 6th of April 17 and the 5th of April 2025, and who are now becoming taxable as from 6th of April 2025 on their worldwide gains as they arrive. So this isn't quite as generous as the 5th of April 29 rebasing date, which was proposed by the previous government, but at least we've got some form of rebasing, which is useful. So moving on then, still with non-DOMs, but now in respect of inheritance tax, because there's been some major changes there as well. So under the current rules, a person's domicile status is what determines their exposure to IHT. And non-DOMs are subject to IHT on their UK assets only. And when a non-DOM's been around in the UK for 15 out of the previous 20 years, they become deemed domiciled, and that means that their worldwide assets, both UK and non-UK assets, are subject to IHT. So traditionally, it's been common for people who are about to become deemed domiciled, it's been common for them to transfer their foreign assets into a non-resident trust in order to protect them from IHT, because that protects those assets even after the individual has become deemed domicile. So that's been sort of standard planning for a lot of people. So that favourable set up for non-DOMs compares to the position for UK domicile, which is quite straightforward, whereby they are just subject to IHT on their worldwide assets. So all this is going to change from 6th of April 2025 with the abolition of the domicile concept. So what we're going to have instead is a residence-based system whereby any non-UK assets will be subject to IHT, where someone has been resident for at least 10 out of the previous 20 years. And that those people are to be known as long-term residents. And that will bring both their UK and their non-UK assets into the scope of IHT. So taxed like a normal UK person, if I can put it like that. And if someone leaves the UK, having been resident here for more than 10 years, they're going to have what's being called an IHT tail for a period of years, which will depend on how long they've been here. So that's going to kind of tie people into this IHT on a worldwide basis. So the tail starts at 3 years for people who have been resident here for 10 to 13 of the previous 20 years. And this increases to a maximum of 10 years for people who have been here for 20 years or more. And when counting up these years, years prior to the 5th of April 2025 are going to be taken into account in calculating the tail. So another big change for non-DOMs will be how IHT is going to be charged on non-UK assets and a non-resident trust at times when the settlor of the trust is long-term resident. So this means that these type of trusts are going to be subject to what we call periodic 10-year charges and exit IHT charges in pretty much the same way as UK trusts are. And in addition, a non-resident trust will be subject to an IHT exit charge if the settlor of that trust ceases to be a long-term resident of the UK, so decides to leave the country. So there's quite a lot there to kind of take in. And as I said, we've done a separate summary on that, which we'll be sending out to all our affected non-DOMs in the next day or two. So turning to inheritance tax a bit more broadly, there had been a lot of speculation around changes to IHT generally, including the abolition of the residence nil rate band, a possible increase in the main IHT rate of 40%. And there was always also talk of a possible change to the 7-year rule for gifting assets. But in the end, thankfully, none of these materialised. So the residence-based system for non-DOMs, which I've just outlined, is going to apply for UK domiciled people as well. And that's actually going to be better for them because it's easier to become non-UK resident than it is to sever your non-UK domiciled status, sever your UK domiciled status. It's difficult to become non-UK domiciled if you're currently UK domiciled because you're almost expected to sort of sever all meaningful ties to the UK, and that's a difficult thing to do. The residency system will be easy for those people, as I said, because it will simply be determined under the statutory residence test. So there's been some other very big changes to IHT across several areas. So a big one was the change to inherited pensions, which are going to be subject to IHT from April 2027 onwards. So currently, unspent defined pensions can be passed on free of tax where somebody dies under the age of 75, or they're taxed at the beneficiary's marginal income tax rate where somebody dies over 75. So from 6th of April 2027, inherited pensions are instead going to be subject to IHT. If a pensioner dies after the age of 75, their unspent pension will be subject to both IHT on the estate and income tax on the beneficiary, which could amount to income tax of 67% if the beneficiary is an additional rate taxpayer. So these are big changes to the way pensions are subject to IHT. The spouse exemption is going to be available for inherited pensions, but where they are left to non-exempt beneficiaries like children, the impact is clearly going to be quite severe here. It's likely that these changes may lead to increased drawing from pensions to give away or spend, and more take up of annuities from which spouses may benefit. It's no longer going to be the good planning tool that it's been for years, since 2015, when I think it was George Osborne changed the rules, which provided that IHT benefit to inherited pensions. So there are also some significant changes to IHT business relief and agricultural relief. So currently, these are very valuable reliefs because they're uncapped, and they can fully protect business and farming assets from IHT. So we're thinking about things like unquoted shares in a family trading company, typically, or a business or farming partnership. And they're of fundamental importance for estate planning. So the current reliefs are 50% or 100%, depending on the type of asset held. So all this is going to change from April 2026, because the reliefs are going to be restricted to £1 million per individual for business and agricultural reliefs. For business and agricultural assets, which currently qualify for 100% relief. So things like unquoted trading company shares and farming partnerships, and any value in excess of this £1 million limit is only going to qualify for 50% protection from IHT. So that will give an effective IHT rate on the excess value of 20%. So the reliefs and the £1 million allowance will apply to death estates, any transfers that might be made into trusts, and any failed pets, which are gifts that are made in the 7 years before somebody passes away. As a result of these changes, we would expect an increase in lifetime giving of business assets to beneficiaries before the changes in April 26. So finally, on IHT, there were some changes to alternative investment market shares. Currently, they can benefit from 100% business relief, but this is being reduced to 50% from April 2026. So this is another significant change. A lot of people have shielded some assets using AIM shares over recent years. So this is quite a big change as well. So all in all, the landscape has changed significantly for non-doms and for those thinking about estate planning. For non-doms, the significant milestones for UK tax have traditionally been years 7, 12 and 15 of UK residents, as this is when they start to pay the remittance basis charge if they want to claim remittance basis, and when they set up non-UK resident trust to protect themselves from IHT in the future. So from 6 April 2025, the new milestones will be the first 4 years of residence for income tax and CGT purposes, and it will be a 10-year period that really people are thinking about for IHT. And because of this change environment, we expect more people to be thinking about becoming non-UK resident under the statutory residence test, and for new arrivals to be probably limiting their stay in the UK if they can. And for IHT, we expect to see a move away from using pensions as a IHT planning tool, as I said, and instead increasing the gifting of business assets to the next generation before the new rules kick in April 2026. So really, that's all I wanted to say for the moment about IHT and non-doms. As I said, we're finalising a paper on the IHT changes, which we'll send out to anybody who hasn't yet received it, who's a non-dom, in the next couple of days. So go back now to Henry to see if there's any questions that have come in.
Yeah, thanks, James. Just having a look through the questions that we did get in. They are largely around, I think, the non-dom and the IHT changes. So I will hand back to James just to go through those ones.
Okay, yeah. So one question that's been asked is whether the any non-dom can benefit from the temporary repatriation facility, and it's quite interesting this because I had to kind of just read it again a couple of times because I had assumed that it was only people who were kind of falling into the new regime from April 2025 who'd be able to benefit from this regime. So not people who have become deemed dom already, you know, and that's basically people who have been here for a long time and are already taxed like normal UK people, if you like. But it appears that the only requirement to make a claim under the temporary repatriation facility is to actually claim a remittance basis um, at some point in the past. So that's actually really good. So my reading of this is that anybody who's claimed the remittance basis, no matter how long ago, if they can identify the income and gains that they claim the remittance basis on, they're going to be able to remit those funds to the UK on favourable terms for that 3-year period that we just talked about. Yeah, so I think there's another question around whether trust income and gains can benefit from the temporary repatriation facility, and they can indeed. So it's not just about personally owned income and gains that can benefit. If people have got settler interested trust income, which has grown over the years, if that's paid out to them prior to the 5th of April 2025, that type of income, trust income and trust gains can also be remitted to the UK in that 3-year period on favourable terms under the temporary repatriation facility as well. So that's another bit of good news really for people who fit that profile. So just one last word actually on the non-dom changes and actually the new residence-based system. So it's actually one of the sort of few winners, if you like, from this budget are going to be people who have been away from the UK for quite some period of time. So people have been away for many, many years. If they meet that new 10-year non-residence requirement, if they move back to the UK, then actually they're not going to be immediately subject to IHT on their non-UK assets when they come back to the UK. That's going to take 10 years to kick in, and they'll actually also benefit from the foreign income and gains regime for that 4-year period as well. So that's quite an interesting benefit for not non-doms, but for non-residents actually who are expats who are thinking about coming back to the UK. So was there anything else, Henry, that caught your eye in the questions, or any other things that we should be addressing?
Not anything that not anything else come through, but of course, if you do guys have any queries, I've got the contact details up on screen. So please, if obviously, I think a few of you will have James's email address or my email address. But of course, please just contact us if you do have any questions about what we're discussing today. Okay, I think that's going to bring the end to our webinar. So I just want to really appreciate everybody for tuning in today. Yeah, like we said, if you do have any questions, please get in contact. However, I will end the webinar and hopefully hear from you guys soon. Thank you very much.
Thanks, everyone.